All right, what's up, everybody? This video is going to be about my strategy for doing a LEAPS, or well, more specifically, it's going to be a poor man's covered call that I'm going to do on a stock, but the first step in that is to acquire a LEAPS. A LEAPS is a long-term equity anticipation security, so it's an acronym, but I'm going to say LEAP from now on because saying LEAPS is just weird. It's awkward. So yeah, I'm going to say a LEAP. And basically, a LEAP it's just a covered call. And we went over that in the last video, but it's basically a covered call way out in the future. So it's going to be a year plus. I think like 9 months plus is the actual time frame that they're considered, but it's basically just a covered call, which is, if you remember, a covered call is where I can sell a covered call and I can sell, so this is for Apple. If I sold a covered call at 125, then I have to sell the stock at that price. Or if I did 200, just to keep it simple. If I did 200, I've sold an option contract for that, for covered call, then I would have to sell it at 200 when the expiration came. Even if it went up to 250, what I would sell it for is 200. So the person buying it would get the stock at 250, but I would only get 200 for it, and then they would get all of the additional profit. Okay, so when you're buying that, you're on the other end of it. Then you become the one who, if it goes way above, then you get to collect that extra money. So I'm going to be doing that on Intel. And there's a lot of reasons that I decided to do Intel. I was talking in past videos about maybe doing it on Winnebago, but I think Intel is going to be a way better choice. And it's just a more stable stock. I think Winnebago is I think they're going to do well, but they're very seasonal. It's going to be during the summer months is when they really pick up sales and all that. And I just kind of want Intel semiconductors really poised for growth right now. Like, it's just going insane, and then there's this huge shortage and everything. So decided to go with Intel. It's also cheaper, which works out. And I'm going to be doing it here. So 370 days out. It's going to expire on the 20th of January in 2023. So next year about this time. Now, if you look here, you can see all the different strikes. And what you'll notice is all these purple ones are considered in the money. And what that means is the stock price is $55.70 right now. So if you look at 55, they're all purple going down. That's because that expiration and that strike, it's already been met. Not that expiration, but that strike has already been met. So if these were to expire today, then they would be considered in the money. Now these are a year out, so the price could move a lot. But if you notice, 57.5, it's not in the money. Kind of irrelevant, just a little bit of exposure if you don't know. I am going to be buying a $40 strike. And that's going to cost me around $1,700. Now, if you're wondering why anybody would do that, it's basically the way it works is every contract for an option is, again, 100 shares. So you basically get to buy 100 shares, but you don't have to actually buy them outright. So if you expect this stock to go up a lot over the next year, then you can put 100 shares in reserve by putting that premium down and buying the contract. And then at any point you can exercise that. So if it shoots up to $70 a share, you can then exercise it and buy 100 shares for $40. So you'd spend $4,000 for a stock that's worth $7,000. But it's not necessarily that simple because you have to factor in the premium because the premium's not calculated in. It's not deducted from the $4,000 that you owe at expiration if it's in the money. So there's a few reasons that I decided on the $40 strike price. The first being is I wanted to balance out how much I was putting down because my account was so small. I didn't really want to go way down here because the premium's just so high, and for my account size, it's just not worth it. 40 is kind of like right in the middle, but if you take a look at the chart, the all-time chart, let's get that up here. Or well, we'll look at, the 5-year. If you look at the 5-year here, the support for the last cycle when it dropped was around 45, a little bit below 44. So we know we have some support here. If you look here and you look here, we have support there. That just means if the stock price drops, there's a lot of people that think this stock is worth 45. So it's really hard to go lower than that. But if you go before that, which this was in 2020 and 2021, if you go even further back, we can look here and see that there's another support level at 42-ish. So we could go for the 42, which would save us money on buying the contract. So if you look at the difference here, 42.5 is what we would have to do. So we could put $200 less and still end up with the same result, basically. However, because I'm being ultra conservative here, I decided to go ahead and give myself a little bit more breathing room. And it just kind of works out with the percentages that I'm trying to work with for long positions and everything. It makes more sense to me to have the barrier of safety and a little extra leeway. So, deciding on if you want to do these kind of boils down to how much you think the stock is going to go up. Now, like I said, you're spending, like me personally, at the 40, I'm going to be spending about $1,700. So that's just money I lose. All right, and I made some slides, so hopefully this is a little bit clearer here. Go to the next one. All right, so I went over why I picked the strike that I did. It's basically a balance between support levels and the cost. So because you spend that premium, you have to make it up somewhere. So the stock has to increase from your strike price more than the premium you spend on it. So for this particular one, because if you look here, it's at 1670, and then the ask is 1715. When you're buying or selling, you kind of look towards the middle of that, and that's going to be the actual price. So in order to, I did 1680 for this example. So you have to make that money back some way. If you bought the stock at 40 or the strike and you spent the 1680, you need the stock price over the next year to increase in an amount that makes up for the premium that you spent on it buying the contract. Okay, so you're basically going to get that from doing the stock strike plus the premium spent. So I need the stock to be at 56.8 or higher by January 22nd, I think it was. No, just the 20th of January. So that's what I need Intel to be at by then, right? That's kind of a big jump. I mean, it's almost a 50% jump. So this is where the poor man's covered call comes in. Now, if you remember, a covered call is basically where you just have 100 shares of a stock and then you sell the right for somebody to purchase those. So you agree on a price above what the actual stock is worth, usually 30 days out. And if the stock goes over that, then somebody can buy it and you only get the strike price even if it goes way higher. So I think we got that down. Okay, so with the poor man's covered call is you can actually run a covered call on that stock without actually owning the shares. Buying a LEAP is considered having 100 shares. So you can use that as collateral for the covered call. Now, an important thing to realize here is that you never really want to get assigned because you don't actually have the 100 shares. That being the case, you usually want to roll these out before expiration. So if you have the covered call, it's getting close, or usually the last. I'm going to do the Monday before expiration. So every Monday before expiration, I'm going to roll it out another month and just keep collecting premium by selling covered calls. And now what's cool is this makes it where your cost basis for what the stock needs to be at the end of the year go down because you're receiving credit every time you sell a covered call. So if you look at the numbers here, if we go to 34 days out, because remember we're going to be selling 30 to 45 days out, so we can simulate this right now. If we look at the delta that we're going to be selling at, which is going to be, I'm going to try to keep it under 32. That's going to be the max. So it's going to be about 90 cents per share. And each contract's worth 100 shares. So $90 for each covered call I sell. So keeping that in mind, we can do that every month and just collect $90 for quote unquote owning 100 shares and hopefully never get assigned, but it's not really because I would pay to lose money before I got assigned. And anyway, that's a whole nother topic. But if you look at that, so if you look at 34 days out, right, which is going to be the average, then it would take 19 months to completely pay off the $16.80 that you put down to buy the LEAP, right? So then at that point, any money that the stock, as long as the stock was over $40, you've won, right? Like you've made money. Now, because I'm only focusing on the next year, I just wanted to kind of break that down. But that's a thing to keep in mind for like really long-term investing, which is ultimately what this will roll into. And this is always going to fluctuate. You know, it's like I was looking last week and I think the premium was only like $40. It's just really a volatile market right now. So the premiums are really high. I think it was only like $40, somewhere around there. So it's going to fluctuate. But the concept is you can keep selling covered calls over and over and over, and eventually you'll get your cost basis down to zero. So then you basically just have the right to buy 100 shares of Intel at $40, no matter what the price is, as long as it's over $40, which is, you know, pretty powerful. All right, so for this series, I'm trying to beat the S&P 500 for next year, so I'm kind of focused on that. So to get the cost basis for 1 year, since we're doing 30 to 45 days out, it's going to be either 11 months, more likely, because of, you know, the 30 to 45 day time frame. It's not going to be exactly 12. But you basically just take the premium paid, which was $16.80. That's how much I used to buy the contract. And then $90, which is the monthly premium received for selling the covered call. And then you multiply that by whatever number you're trying to get. For us, it's going to be 12. That means our cost basis would only be $600. So now, instead of being at 56, I think it was, that it needed to be for us to be profitable on buying a LEAP, it only needs to be 46. Well, the stock's already at 55.70. So that's a pretty big drop to have it go down to 46. And yeah, I mean, it's just kind of free money. It can go against you, like I said, if you buy a covered call and the price just shoots up and then you have to buy back that covered call you sold, then you'll end up losing a little bit of money doing the covered calls. But the idea is the main thing, is that by selling the covered calls, eventually you will whittle away at your purchase price. And that can go for whether it's stocks you own or for the LEAPS. And that's really all it's about, is you want to, keep making money to decrease the cost of the stocks you do own or are going to own, and then using that money elsewhere to buy more stocks. So yeah, that's going to be it. I just wanted to do a brief overview of that. I decided to go with Intel. There's kind of a lot of reasons. The main one is the CEO. I was kind of unsure about him when everything first went down, when they got the new one in, because he's not a businessman at all. He is really just this nerdy guy who has been at Intel for 30 years. But after reading a little bit more and watching some stuff on YouTube, the enthusiasm is there. I mean, this guy knows his stuff, and he has the charisma to really get people behind him. So Intel's been kind of in this weird period where they just had a bunch of businessmen as CEOs, and they were like cutting costs and downgrading and doing anything they could to get extra money on the books, but it came at a sacrifice of growing the company. And they kind of lagged behind with like their technology and things that they were developing. And this guy is not about that. He's 100% wants to innovate, and that's where his focus is going to be. So with that, they're already planning on building 2 new plants in Arizona to expand their capacity to produce things. He's expanding the research department, which I think is the biggest thing for any technology company, is you got to stay competitive, and he seems to know that, because technology is such a fast-paced business that once you fall behind, it's very, very difficult to get caught back up. Anyway, they have some big things. They have an Amazon contract, something to do with the packaging services. I don't know a whole lot about that, but anything to do with Amazon seems to be a moneymaker. They do have a partnership with Qualcomm, which is a pretty big company. I think they're a semiconductor company. I've heard a lot about them, like watching other investors, but I don't know what they actually do. So I just know that if other people are talking about Qualcomm and then they partnered with them, that's got to be a win, right? If everybody's talking about it, all I hear is good things, and they partnered with them, cool. They will spend heavily. So this is kind of where the whole LEAP strategy thing takes a hiccup, because they're going to be spending a lot of money, which means they're going to be making less money this year. Now, there's going to be probably the majority of people, they don't care about Intel spending money so next year they'll be way better. They just want money now, which is what the old CEOs would do, is they were sacrificing that future growth by giving investors what they wanted now. However, if you can get past that, it usually works out way better in the long run. However, that may stagnate the price a lot this year, which could be really bad for returns, like, on paper for the year. However, that's a risk I'm kind of willing to take, and like I said, I can run the covered calls on it, so it will mitigate some of that. And Intel's a stable company. It's not going to be really up and down, up and down, up and down. It's a solid company. They've been around for a long time. They know what they're doing. With that being said, I don't think they're going to be a big winner this year unless people really do just get behind the semiconductor. And that's a very, very distinct possibility because that shit is going absolutely crazy right now. Everybody is getting in on it, investor-wise. Everybody wants a piece of it. Intel's kind of been overlooked because of, their past CEOs not really prioritizing what it was that they were developing. However, if they start changing the game up, people may start throwing money at them too, which could make the price go way, way, way up. So that would be awesome. But like I said, it is kind of a gamble. People like seeing $6 billion in revenue and then all the growth in sales. And yeah, it's main thing. They're going to be spending a lot of money for future growth. So it kind of works out because I'm getting the shares at 40. I'm going to keep running the covered calls on them. So eventually my cost basis will be at 40. So if they do drop this year, then next year, when the fruits of the labor kind of start being seen, I'll have shares at $40, and then hopefully they'll skyrocket from there. But anyway, that's getting way too far ahead of it. I wanted to get all my shit in order before I did buy a LEAPS. I wanted to have my cash balance secured. I wanted to have my long position secured. I wanted to be running options plays with like credit spreads and iron condors and shit, but that's kind of not looking like it's going to happen, and I need to get in on this LEAP right now. So I think next week I'm going to be buying the LEAP and start running covered calls on it immediately. The reason I need to get in right now is because if we look down here, we have 370 days until the 20 Jan 23 expiration. I really need it to be over a year for tax reasons. So I'm kind of running out of time in that regard. I have the cash right now to do it, so it's not like I'm going on margin or anything, but I need to do it. Another thing is the PE is really, really low right now. The price to earnings, it's really, really low right now. If people respond well to all the changes Intel are doing, that PE is going to go way up, and I would like to have it. Basically, it's just having it at a lower cost for the stock. If the price goes up, then basically you'll be earning less per share. So it's better to have the low PE. Yeah, that's the gist of it. The only other thing is, because I am going with Intel over Winnebago, like I talked about in the past, I am probably not going to have Microsoft as a part of my foundation. Just because they're so closely correlated. They do a lot of business together, and I don't know, I just already have so much exposure to technology as a whole in my portfolio anyway, with Apple and everything else. I'm going to have the semiconductor ETF, and I don't know, I need to branch out a little bit and get involved in another industry. That way, if something bad happens in the technology sector, then my whole portfolio is not just wiped out, you know what I'm saying? So yeah, probably I'm going to drop Microsoft. I don't know if I'll add something in its place. I think it will probably be either some type of precious metal or oil, probably oil. That's another thing. That's a whole nother video, and I'll talk about that in another time. But yeah, I'm going to go ahead and call this one quits because it is already way longer than I expected it to be. So good luck with everything. Yeah, take it easy.